Hello, everyone. Good evening, friends, or good afternoon, depending on where you are logging in from. I welcome you guys all in today's Let's Chat Real Estate episode in this live webinar tonight. And currently, we are having this webinar at 6 p.m., but there is a quick announcement. So, from next week onwards, we will be having these webinars every Tuesday, but starting at 8 p.m. Australian Eastern Standard Time. So these webinars will continue on Tuesdays, but from next week they will be at 8 p.m. because I think that is a better time in terms of people finishing their day-to-day life and having a bit more peace and control over their time. So that was just a quick announcement. And today I have some really very good information to share with you. Definitely we had the cash rate announcement coming through as well today. So we will be talking about that as well. My name is Adil Rizvi and I'm a property strategist, and I'm here tonight to take your questions, be it for first home buyers or whether you are an investor trying to contemplate the idea of investing in today's market, or you're looking to build a property portfolio, like you already have done one or two investments and now you're looking to grow and excel. So you can be in any stage of your life, or you're just here to learn. You may not be ready to buy right now, you may not be looking to buy, but you just want to understand what's happening in the real estate market. So we will be discussing quite a lot of information and also going through your questions today. I will be looking at my mobile just to make sure I don't miss on any of the questions, because sometimes this live streaming can be a bit tricky where some of your questions may not appear in the comments. So please, if you're joining live or if you will be watching it later, make sure you leave your feedback in the comment section. Leave your question over there. That's what we are here for. We want to hear from you. I want your questions over there so that we can answer them as well. So type in your questions now, regardless of what it is. There is nothing like a stupid question. And if you're watching the recording later on, tomorrow, day after, whenever, please type in your question and I would be answering that in the following week, which will be next Tuesday. So just before I begin, very quickly, a disclaimer: any information presented in this particular webinar today is not a financial advice by any shape or form. So make sure any information that you pick from this webinar, you do your own due diligence and you seek your own professional independent advice before you decide to act on any of the information. So that was a disclaimer which is very essential. And we will be taking your questions as well tonight. We had a comment from a LinkedIn user. They're looking forward to tonight's chat. I'm looking forward to it as well. Thank you so very much. I couldn't see your name for some reason. It's not displaying here, but I'll quickly share some of the interesting stuff that I want to share with you guys, because there's always something happening in the property market, right? So very quickly, let me share, let me present this. Okay, so I'll be presenting my screen over here. There you go. Now, so what, this is a slide which is exactly from last week. Very quick recap. Just shows where the people are putting money in Australian real estate. Like most of the wealth, around 57%, is invested in Australian real estate. That shows how much trustworthy this particular asset type is. Again, we are not comparing between different asset classes. I'm not certified to do that, but it just shows that how much trust people have had in Australia over the decades, that they have been putting their money in the real estate, and that's where they trust their money works really well. Apart from that, most of the people don't really get concerned when the interest rates move a lot, because the overall or the national loan to value ratio is only 22%, right? So that is relatively a very small number. Again, a lot of households do get affected by interest rate movements, that is for sure, and they are feeling it right now as well. The cash flows are a challenge, household budgets are a challenge right now, but at a national level, the impact is not as huge as you hear that in the media, right? Now we have a couple of questions coming through. One is from Muhammad Ahmed, the other one is from Muhammad Kumel, and we will be taking those questions. One is around super, one is around Melbourne. So stick around, I'll be taking those questions shortly. I just want to quickly go through some of the key developments which have happened in the past week. So the cash rate announcement came through today. I'll be rushing through it very, very quickly. The cash rate has stayed at 4.35%. I don't want to be the 63rd person to tell you about it. You probably already have heard it, but there is a bit of a background around it. And I think that was a very sane decision. A lot of people are talking about interest rate cuts, potential cuts, but I think any rate cuts anytime sooner in the next 1 or 2 months may actually mean that they may have to rise the interest rates faster after 6 months. And why I say that, because inflation, as you can see in the June quarter, it's still sitting at 3.8%, which is slightly off from the target band of 2 to 3%, and it is sticky. They've been calling it sticky. It's not going down as it was expected, and it is not impacting the house prices as well. So house prices are also not going down, and I will discuss about that with a very interesting graph we have from ABS today. So what happened in the US recently was that they moved their cash rate down by 50 basis points last week. And a lot of times Australian economy kind of follows what happens in the US. I was reading a very interesting comment today where someone said, if the RBA is really, and that is their comment, I don't necessarily agree or disagree with that, but they said, if the RBA is independent, they would keep the cash rate as is. If they are not independent, then we may expect a rate cut. And you know what that really means is, right? But the influence of the US decisions and the US economy on the Australian economy is pretty much obvious. So that's why there were a few people after last week's cut by the US, they were kind of speculating that the interest rates may start going down sooner. Not many people were expecting that to happen today, of course. But again, that is still the climate right now. But I feel the way inflation is sticking around, it's better that the interest rates stay where they are right now. And also the unemployment in the last 6 months has actually gone up. It's sitting at around 4.2% as of July 24. So we have to be very careful. Bringing the interest rates further up means unemployment may rise. Bringing it further down means that we may have much more spending and the inflation can go up. So it's a very fine line that RBI has to walk through. Whether they increase the interest rate or decrease the interest rate, it's not so simple. So even though it may not seem like a big change to a lot of people that the interest rate has stayed the same, but I'm sure there has been a lot of thinking behind all of this data that they have taken this decision. So I totally feel that they have done a very, very good thing at this point. Now, very quickly, what are the major banks saying at this stage? What do they think about the rate cuts? So all the 4 major banks believe that interest rates will start coming down sometime next year. ANZ is saying early next year, same as Westpac, according to their latest weekly report. CBA is even predicting a rate cut later this year, right? So they are expecting a December Christmas gift from the RBA. Again, I'm a bit speculative personally on that. That's my personal view. But NAB is predicting around mid next year for the first rate cut. But we will have to keep a close eye on how the inflation actually tracks and how the unemployment also tracks, right? Now, one thing that I wanted to touch upon today is the buyer activity and how it has been going up. Now, I will share a very interesting graph with you, but very quickly, if you look at this table, what we are looking over here is there are different kinds of buyers, right? So we have owner occupiers, which are the first home buyers. So in this first column, we have the first home buyers. Second column shows, again, the owner occupiers, but not first home buyers, right? So these are the buyers who are taking loans to probably upgrade their home. They're probably buying their second owner occupier and selling the first one, or their third owner occupier, and they've sold 2 of the other ones previously, or they've converted them into investment properties, right? So having said that, the last column over here is for investor loans only. Now, what this table essentially is showing that how many loans have been taken out by people as investors, as first home buyers, and as owner occupiers who are not first home buyers, right? Now, Again, we have another question. Thank you so very much for that question about buying property outside of Sydney. We will definitely talk about that as well. But thank you guys for your questions and comments. Please keep sending them through. I mean, we really want you to be participating and putting your questions through, because that gives us the right indication of what you want to learn about. And this session is all about your learning, right? So if you notice over here, in the last, from June, even in the last year, right, around 19.7% loans have been taken out by first home buyers. The people who have upgraded their family homes, like they're still owner occupiers, but they're not first home buyers, they're around 21.4. But the majority of activity has been done by the investors in the last 1 year. They have taken out 35.4% of, that is a 35.4% increase in the loan activity. And that is a big increase considering interest rates have been going up. Remember, the interest rates have been stable at 4.35%. The cash rate has been stable over there since November last year. So even though it has been stable for the last 10 months, but it has risen over the last 2 years. And that is where I want to show you one more detailed graph of the same thing, which will tell you what's the buyer sentiment right now. What are they doing? What is the buyer sentiment in terms of what the media is saying, right? There's a question about Newcastle region and Maitland. Definitely, we will be taking that as well. This is the last piece of information we are talking about. Then we will go to the questions. So very quickly, I want to share this thing with you guys, which will really be an eye-opener for a lot of people. And there you go, right? So this is the same table from which I extracted the previous table, right? Now what we are focusing on over here is, if you look over here, these are three different graphs. This red one is pretty much showing the loans that the first home buyers have been taking, and that has been pretty consistent in the last 1 year, right? So in July 23, they took out loans of $4.46 billion. Now it is sitting at 5.3, so not much increase. So first home buyer activity has been kind of consistent, right? And that is across the nation, across the entire country. You look at the owner occupier activity, which are not first home buyers, but they are upgraders. They are buying their second family home or third family home, right? So their activity has been since last, we are comparing last 1 year, right? From July 23 onwards. So at that point of time, their activity has gone up from, let's say, 11 billion loans all the way up to 13.5 billion loans. So that is a significant increase. But one thing where the increase has been the most is the investor loans. In July 23, the investor loans taken out was 8.6 billion. It currently sits at 11.7%. So that is the difference of 35% that we are talking about, right? And what happened before that? If you guys remember what happened at the time of COVID, right? Yes, there's a cap on immigration and student visa as well. We will touch on that as well. So in May 2022, the interest rates started going up, right? So if we draw a line in the sand from June 22 onwards, if you see this particular graph, the first home buyer activity has kind of remained consistent. It went down a little bit on this red graph. It has kind of stayed consistent. But the owner occupier activity for people who are buying their second family home or they're upgrading their family home, their activity has really dipped since the interest rates started going up. So their total loan commitment for the month of June 22, when the interest rate started going up, was 15 billion. It is actually reduced down to 13 billion now, right? What has happened in the investor world? In June 22, the investor loan commitment was $10 billion, right? And that is the only one which has significantly increased up to 11.7 billion. What that means is that while the interest rates have gone up and affordability has been a challenge for home buyers, investors, but it has not impacted them alike. A lot of investor activity is still happening, and it is actually leading the way, as opposed to a lot of media articles where people say, oh, you should not be looking to invest right now. You should rather be looking to just buy own home or your own property because the interest rates are so high. The numbers clearly show over here that the investor activity has been leading the new loan commitments. Now, what it means is, doesn't necessarily mean that I'm asking you to go and start investing blindly. That's not the idea. The idea is that investor activity is still leading the charts across the country. It is that is where the loan commitment in terms of percentage is rising the most in the last 12 to 24 months. And if you are sitting on the side as an investor thinking that other people are not investing or they are not doing any of the investing activity and they are also waiting for interest rates to fall down, you just need to look at this graph. This is actually rising, and this is having the most steep rise when compared to owner occupiers. So that is what I wanted to share with you. I'll stop. I'll quickly be looking at some of the questions right now. So we have a question from, okay, so Mr. Mohammed 𝐏𝐿 𝐀𝐄𝐒𝐓, you mentioned about you building your own house using super money. Now, typically when you have your super fund and you want to use your super money, again, whatever I'm discussing over here, it's not a tax advice. Make sure you discuss all your matters around super with a licensed accountant who's experienced in SMSF advice, and not just rely on what we are sharing over here. But as per my understanding, when you talk about super, if you buy any property under super, like under your SMSF, you cannot live in that property. You cannot even rent it out to yourself. You cannot even rent it out to your relatives. So that is a limitation around buying property in SMSF. Now, if you want to build your own house using super money, again, that may be possible in a very complicated structure, because I've been having chats with some accountants and they've mentioned that is potentially possible. I'm not saying it is. So it's the best way would be that you discuss with an experienced accountant around that question. And if you want an introduction to be connected with an experienced accountant, drop your email address and your contact number in the comments. If it's you, Mohammed, Ahmed, Shoaib, or anyone else, if you want to know how you can leverage your super, whether you can use it to build your own home, as far as I know, you cannot. But again, if you want to be connected with an experienced accountant, I'm more than happy to make that introduction for you. Investing in Melbourne, that is on the cards for a while, guys. Melbourne has been the slowest performer over the last 3 years since COVID. It had its own reasons, a lot of lockdowns, the most locked down city, not just in Australia, but in the world, right? So it has had its fair share of lockdowns, and it has had other economical factors as well, change of government, a lot of things, and the property market has been really slow in Melbourne. But if it comes to investing, if you are an investor who wants to make that real good 30-40% capital growth in the next 3 to 4 years, most of the areas in Melbourne are not ready for that yet. I'm saying that based on looking after at a lot of data. What data we are talking about? We are looking at wage growth. We are looking at supply. There are a lot more properties in some of those affordable areas than the demand in those areas. So it's taking longer for those properties to sell, which means the price increase is also very slow because the demand is slow. Not many people are competing for them. So if you're looking for quick price growth in the next 3 to 5 years, let's say 30, 40, 50% growth, like a lot of our clients have been having, a lot of good investors or strategic investors want to have that kind of growth, Melbourne is not the place right now. Most of the suburbs in Melbourne will not tick that box. But having said that, if you want to buy something where you're not worried about capital growth, let's say for the next 12 or 18 months, and after 12, 18 months, if the capital growth starts slowly, you are only looking to buy something long term. Let's say you want to buy something for the next 10 years and you don't have any plans to use that equity to buy any other asset, then yes, you can potentially look at Melbourne. But make sure that you are looking at the local dynamics so that you can actually capture that early growth. If not within the first 12 months, then after the first 12, 18 months, you should be able to capture that growth. So yes, Melbourne is open for that kind of investing strategy where you're investing for the longer run. Now, so thanks, Saud, mentioning about living in Western Sydney. I want to buy in Brisbane and also heard about Perth. Is flying out to check a property before buying it the right way, or are there any tips around that? Well, flying out to buy your property as an investment does not really work. And a lot of people ask this question. What you need to do is you need to understand you need to do proper due diligence before you buy the property. And there are ways where trusted professionals can do due diligence on your behalf. We buy a lot of properties for our clients interstate. Most of our work is outside of Sydney right now. Doesn't necessarily mean that I am flying for each property purchase or for each open home, right? So how you can go about this is first you have to identify the right area where you think that you should be investing or buying in. Once you have identified that, and it's a step-by-step thorough process of suburb selection. Once you have gone through that process, after that you have to find the best real estate agents in that area, or the best property managers, I should say. Those property managers will give you those extra insights which are not available in the raw data. For example, a data or a council map can tell you that this particular suburb does not flood. There's no flooding over here. But that data may not always be accurate. Sometimes it is a bit outdated. Sometimes it's not just accurate, right? So that's when you actually reach out to that local property manager who's experienced in that suburb, who have been managing properties in that suburb, and ask them the question: that is this area really flooding? Has this area flooded in the last 5 years? Like, there were some severe floods in Brisbane back in 2017, 2019, right? So if we are buying in Brisbane, let's say in Logan Council, we are not buying in Logan right now, but once we were buying over there back in 21, 22, that's what we used to do. We used to call the local real estate agents and ask them the question that the council map is showing, our Archistar and other paid tools that we have, they are showing that this is not a flood area. But can you really confirm if it flooded when the last big floods actually happened? Because if it did not flood at the time of the big floods that happened 3, 4, 5, 6 years ago, then the likelihood is it is not in a flood zone, right? So you have to do your due diligence through the local property managers. And these are the property managers who will also be able to inspect the property on your behalf. So you don't need to travel to Perth every time. It's a 4 or 5 hour flight to Perth if you're going from Sydney or Melbourne, right? You don't have to fly every time. But if you have the right people in there, you can always ask them this question. And they will be doing not just the due diligence for you, but they can do the property inspection. So they know what to look into a property. They know how to identify the defects. They know how to look behind the cosmetic paints. If someone has painted the property, but there's probably a broken wall behind, or there's some leakage happening in the shower, they would know that because they do it day in and day out. So get the right property managers on your side, and they will not just do the due diligence, but they will also provide the right suburb information, so that your investing decision is not a guesswork anymore, right? Now, how do you select a good property manager? If that's your question, then the best way is what we have been using as well. Is there are multiple websites. The one of the most trusted websites is ratemyagent.com.au. Rate My Agent. You go to that website, you enter the suburb where you want to buy in. Of course, you need to know the suburb where you are looking to buy interstate. As soon as you enter the suburb and you search for property managers, it will show you all the names, and it will rank them as well based on their reviews. Now, Rate My Agent is something similar to what we have like Google reviews, right? But Rate My Agent is a platform where you can leave a review for real estate agent or a property manager. So it's a very trusted platform. So looking at the reviews, you can pick your top 3, 4, 5 agents, and you actually start having a chat with them. Give them a call and ask them, I'm looking to buy in this area. Should I be considering it? What I'm doing, do you think it's stupid? Is it the right way of doing it? And you can ask questions, and most of the time they will be willing to help you, because at the end of the day, if they do a good job and they get the right due diligence done for you, guess what? You also want someone to manage that property later on. Once you have it purchased, you will have a tenant coming in. So that's where that tenant needs to be screened, a tenant needs to be looked after, and that's where you need a property manager. So these property managers, if they are the good property managers, they know that if they provide you a good job, in return, the likelihood is that they will get property management for your particular asset. So it's a win-win for both the sides, right? So that is what you can do. You don't need to fly out every time. I hope that answers your question. There was a question around Newcastle region and Maitland for a good return on investment in the next 5 or 7 years. That is one of the very good regions right now. If you talk about a little south from Newcastle, which was Central Coast, it had really good growth. Just on the COVID onset, it really did well. It has been a bit on a slower side, I would say, for the last 18 months or so. But once you talk about Newcastle, the Hunter Valley, the Maitland, I think Maitland definitely is one of the very good areas where you can keep your eye on. And again, the standard remains the same, the formula remains the same. Make sure you're buying in an area where you don't buy in an oversupply area. So please Make sure you do the checks as to what the council plans are in the future. If you are buying in a suburb where council is planning to bring high density apartments or a lot of townhouses in the next 2 3 years, the problem is that your property, if you purchase it today, it will just be another property in the middle of a lot of other new stock. And guess what? Not many people would want to buy your established property if there is a lot other stock available which is brand new. So that's where you have to be buying in areas where the supply side is low. And there are areas around Maitland, there are some suburbs where definitely you can achieve that. Another thing you need to be careful of in buying in Maitland or any other area, make sure that you know what the median is in that area. And not every properties, like no two properties are exactly the same. But if you know that the median of the area is, let's say, around 700K as an example, then you should not be buying a house potentially that is sitting at 900K for the same configuration, because you are buying way above the median, and you may struggle with valuations when you put an offer in, because there won't be much comparable sales for that value because you are buying above the market value. So be very careful in the type of property you select as well. You may be in the best possible suburb which will have enough growth, but if you buy over the market value, essentially what you will do is you will actually lose a lot of equity from day one. So be very careful about that as well. The cap on immigration student visa should impact property prices in the short term. So definitely immigration and student visas cap is important, but by the time it takes effect, like in the last 12 months, the total number of migrants, I was reading it on ABS website, the total population increase up until March 24 has been 680,000 people. So until March, so in 1 year, up till March 24, we had our population increased by 680,000 people roughly. Out of them, 83% of population increase was purely based on migration. Only 105,000 people were the ones who increased the population because of natural birth. Now, yes, the government talks about that they will pause the migration, they will slow it down, and they have forecasted smaller number of immigration for the following years as well. But the thing is that Australian economy is heavy. I've said it somewhere else as well. I don't mind it repeating that. The Australian economy is driven by two major things which really drive the economy. One is the real estate market, the property market. You just imagine how many industries are associated with real estate, be it building industries, councils, approvals, the jobs, construction industry, infrastructure, all that falls in and around real estate. So that is one big industry. That's where the economy runs from. The second biggest economic driver is immigration. People come from overseas, they bring a lot of money, they bring a lot of expertise, and they are the fuel to our local economy, and that has been the case for decades, right? So yes, they talk about slowing immigration down, but they can't slow it down to the pre-COVID level. The pre-COVID level was around 160 to 180,000 migrants coming into the country every single year. So I don't think they will go down to that level. They are talking about 400,000 and 500,000 moving forward. And if they do that, that will be even better. But that, even if they reduce it to 400,000 people every year, guess what? That 400,000 number is still much bigger than the pre-COVID level. The pre-COVID level was 160, 180,000 people coming as new migrants. So I don't think it will have a huge impact on the prices, because again, it's not just the demand, it's also about the supply. Yes, the demand will go down a little bit because the migration numbers will drop, let's say from 550, 600,000 people to 400,000. Yeah, that's a big drop. I understand that. But what about the supply? The construction costs are going high, right? It's becoming more and more difficult to build your own home. People who want to build, ask them the question, how easily can they build their homes? So because it's becoming more difficult and more expensive to build new homes, supply is not coming into the market. New homes are not coming in. Yes, demand has gone down or will go down a little bit, but the gap will still be there between supply and demand, which means more competition or sustained competition for properties across the country, especially where the economy is diverse and where there are multiple job opportunities for people, because that's where people want to live, right? So thank you guys for your questions. I'm just making sure that If you have any other questions, I'll just quickly check through my mobile that we haven't missed anything. We are right on time. If we have any other question, we will take it. Otherwise, we can call it a day. So just bear with me. Okay. Okay, so I'm just looking at the questions. I think we have addressed all the questions, guys, that you have posted on YouTube. Let me quickly check the other platforms as well. And guys, if you are watching it as a recording, please leave your questions whenever you watch it, because we will address those questions in the following week's webinar. And from the following week, please, we will be having this webinar every Tuesday, but at a different time. We will be having it 8 p.m. because 6 p.m. is a bit tricky for people to join. So from following week, this webinar will be happening at 8 p.m. so that you can be comfortable after your dinner and join this and participate live as well. But if you're not live at the moment, that's perfectly okay. We can still answer your questions. If you want to post that in the comment section, whether on LinkedIn or on YouTube, more than happy to answer them for you. So okay, so I'm just quickly going through some of these. Hey Margaret, thank you so very much. That was you, right? Looking forward for tonight's chat. Margaret, a very good friend. Thank you for tuning in, Margaret. I think we are done at this point of time. There are no more questions, guys. So please let me know what you want to hear about, what you want to listen to. The market is still very, very active, and people have kind of get used to the high interest rates, which are kind of normal interest rates. If you look at the history, what interest rates used to be like 5 years and 10 years ago. So 6%, 6.5% is something what people are used to now. So if you're looking for any insights, if you have any other questions, please join us next week and we would love to answer your question. Until then, take care. Have a very good night. See ya.